In shocking news for today, Disney stock is actually up 10% after the company released earnings, but it wasn't really earnings that investors were worried about. It was the company announcing a new theme park, a seventh theme park that's going to be in Abu Dhabi. I want to dig through exactly where this theme park is, what it's potentially going to look like, and what the impact will be on the company's financials. And then let's go through some of the numbers because they were actually pretty good from Disney in the second fiscal quarter of the year. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's look at what was actually announced. This is the release from Disney. Disney announces plans for a new theme park and resort with Miral in Abu Dhabi. There's a lot of interesting details, like the fact that Disney is not actually going to put any money into this. But let's start with a little bit bigger picture, like where in the world is this resort? This is Abu Dhabi right here, and specifically this is Yas Island. But let's look at where Disney has operations today. They have a resort in Japan. They have one in Shanghai, China, which is right about here. They have another one in Hong Kong, which is down here. They have another one in France, and obviously 2 in the US. Those are the 6 operating resorts that they have today. So this entire part of the world, well over 1 billion people living in this part of the world, is very, very far from any sort of Disney resort. That's the reason that this is an attractive opportunity. It is a perfect space, just from a geographic standpoint, for Disney to build a resort. But let's zoom in and look at exactly where Yas Island is in Abu Dhabi. If you are a Formula One fan, you may recognize this is Yas Marina Circuit for Formula One. Ferrari also has a space here, a very, very big building from Ferrari. And this is really becoming the entertainment hub of this part of Abu Dhabi. Now, one of the interesting things, they didn't disclose exactly where this resort is going to be. These are artificial islands, so it's very possible that they add some space up here. And if this has been disclosed in the hours since, let me know in the comment section below. But I cannot find any sort of indication of exactly where this is going to be. But based on the pictures, it's going to be either kind of up here at the tip or on an additional part of the island. So a couple of the interesting things here. This is within a 4-hour flight of 1/3 of the world's population. So that's what I'm talking about. There's a ton of people in this part of the world. And this property is going to be actually owned by Miral. It's going to be licensing IP, and then Disney's going to be doing a lot of the design work, things like that. So basically no financial risk for Disney. So that's why it's pure upside. I think that's one of the reasons that the stock is up so much today. To put a little context into why this is so important, let's go through some of the results, because the experiences business has been really the bright spot for Disney. I think the optionality for the stock really comes from ESPN going over the top. That's going to be happening in the next few months. Bob Iger said that Jimmy Pitaro, who is running ESPN, is actually going to make an announcement next week. So if that happens and we see what pricing is going to look like and what the offering is going to look like, I will be back to cover that, because I think that's going to be a really interesting bundle for Disney. Sounds like they're already just going to be giving access to everybody that has a linear TV subscription, but potentially pulling some of those customers over to streaming and becoming one of the top 3 streaming companies in the world behind YouTube and Netflix. Could potentially even pass Netflix in the next couple of years in revenue. I don't think a lot of people are talking about that, but that's a really interesting piece. But the core for Disney right now is going to be their experiences business. And here's the quarterly summary. This has got revenue on the top here, and operating income is the second section. I think this is always a good place to start for Disney. So you can see that the entertainment business, which includes their movies, it includes direct to consumer, that was up 9%. So pretty good quarter for entertainment, and for the first 6 months of the year, up 9%. Sports, big surprise here, I think. Revenue was up 5% and up 3% for the first half of the year. And experiences continues to be really solid. When you hear a lot of things like, you know what, Canadians aren't coming to the US anymore, we're not seeing that in any of the numbers. And management talked a lot about that on the conference call, that there's not a lot of indication that traveling is going to slow down, at least in the foreseeable future. Maybe if we go into a recession, people will stop spending a little bit more. But bookings, as far as the next quarter or two go, seem like they're up at least kind of in low single digits. So what you would expect from an incrementally getting stronger business. So that experiences business was up 6%. Operating income, sports was actually down a little bit, but entertainment is improving. That's in large part because of improved profitability in the streaming business. Let's start with this experiences business, because I do think these numbers are interesting. The weakness that they are seeing here, down 5% in revenue on the international side. Most of this is coming from China. This is not necessarily fewer people going to the parks, but they said that there was less spending from people at parks in the Shanghai park in particular. Domestic, so this is going to be Florida and California, Disney World and Disneyland, up 9%. So again, that goes against the narrative that I think is in the market right now that traveling is really weak and people aren't going to go to Disney World. That's just not happening. And even domestic operating income up 13%. The run rate, look at this run rate here, now almost at $10 billion per year. Sports also showing strength. Revenue was up 7% at ESPN and domestically, and then 11% internationally. Operating income is going to be down a little bit. That's going to be because of some of those increased sports rights. But look at this quarterly revenue here, a run rate of about $18 billion. Now, ESPN is going to be going over the top within the next few months. So figure probably in August or so, based on what management has said. And again, we'll find out more next week. But let's say that they're able to add 50 million subscribers at $20 per month in total revenue. That's going to be the premium that you pay plus any advertising revenue. That would be another $12 billion worth of revenue. This is where I think there's going to be a lot of upside over the next couple of years for Disney, is increasing the revenue that's going on in the sports side of the business and ESPN going over the top. So keep an eye on that one because this is a pretty strong business right now. This is where advertisers want to be. This is the one thing that's kind of holding cable together. ESPN going over the top is going to be pretty big news. And finally, let's look at this direct-to-consumer business. This is streaming. They should just call this streaming. $6.1 billion worth of revenue. Like I said, ESPN, $3 billion of revenue per quarter. That would be that $12 billion run rate that I just talked about. That's not crazy because right now, Disney Plus and Hulu already doing $6 billion per quarter, now becoming pretty profitable. This is not a high operating margin business yet. I think eventually this could be a 10 to 20% operating margin business, but right now, we're at about 5%. So at $336 million in operating income, this is no longer a drag on the business. It's now helping the business. And the subscriber numbers are at least slowly and incrementally moving in the right direction with Disney Plus adding 2% to their subscribers domestically, 1% internationally, 1% overall to 126 million. Hulu continues to be pretty strong with 54.7 million people, and then they're also increasing prices. So that's another reason that you're going to have higher margins and higher revenue, because you're adding a few subscribers and then ratcheting up those prices slowly on those subscribers. So add all of this together, and I think Disney is actually sitting in a pretty good position. Management is still expecting $5.75 in adjusted earnings per share this year, even after the stock pop today. Shares are about $101.53 as I'm recording. That's a price to earnings multiple that's under 18 right now. That's a pretty reasonable price to pay for a company that has tailwinds in the experiences business, and I think could have a lot of optionality with ESPN going over the top. So this is a stock that I own and will continue to own. And if we get some buying opportunities in the $80, $90 range like we've gotten over the past few months, wouldn't mind adding more Disney. But let me know what you think of Disney stock today after the earnings report and the announcement that they're going to be going to Abu Dhabi. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.